The Redbox stock has been the topic of many conversations lately, and in today's video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile at the moment, we should always be mindful about which positions to choose, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, the price action of Redbox has brought the stock to around $2.68 before stabilizing around the current $15.82. Redbox had an amazing run over the past few months or so, and this tendency has even accelerated in today's trading session as the uptrend tendency continued for at least another 50% from where things were left on Friday. Redbox has one key element that we should take into consideration, and that is short interest the stock has versus the trading volume that there will be during trading sessions. Since the company is basically a DVD rental service, we know very well that there will be significant hurdles and challenges from a purely fundamental perspective, much like the business model of GameStop. That certainly didn't stop people from going all in for the title, but we have to keep in mind that a key reason pushing the stock up is the short squeeze, and the additional caution would be highly advised if the intention is to hold the stock long term. Currently, different data aggregator websites state that the short interest remain very high, around 40% as of June the 10th. We should definitely track the short interest in the days and weeks to come, and to begin unloading the position as the effect of the squeeze begins to play. Meanwhile, I think that the stock is definitely ripe for trading and to benefit from the short-term volatilities, but would also caution against overexposure and to affect the balance of your entire portfolio in one single position. Now, let's also take a look at the technicals of the stock. The trading volume of Redbox has recently been 40 million shares versus the average of 26 million shares. Over the past 52-week period, its price fluctuated between $1.61 and $27.22. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the stock. When we use it to compare it with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through current resistance levels. Even when the current volume is lower than the anticipated average, it is an interesting indication because this may signify that a trend reversal may happen soon. The market cap of Redbox is currently around $725 million compared to the enterprise value of around $300 million. To put simply, the market cap is the fair market value the company is based on, with the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning that they're not items, inventory, or equipments, but promises that this company can grow significantly in the future, such as pledges for major contracts, blueprints for new products, and new management. For startups, most of their valuations are based on these intangibles, which may have been valued in more favorable conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market that the company is trading at a discount. This may not always be the case. It may also be trading below the book value, but doesn't mean that the company itself is undervalued. It's also possible that the company was overvalued to begin with, and it's now deflating. As we compare the current price to the historical price fluctuations, the stock is 567% higher than the 1-month low, 888% higher than the 3-month low, and almost 1,000% higher than its 52-week low. On the options market, which gives a hint about where the market sentiment is and where the stock price is likely going to head next, the implied volatility is 340% versus a historical volatility of 320%. The put-call volume ratio is currently around 0.32. It is normal for many stocks to tend to have a higher put option volume than what they truly deserve, since many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 80,000 contracts a day versus the 30-day average of 53,000. In terms of open interest, the most recent volume of open interest is 237,000 contracts versus the 30-day average of 121,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you the obligation to execute the right in exchange of premiums. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there may be possible uptrend on the move, or that the reversal may happen if there's a lot of call options. The reasoning behind that theory is quite simple, and this is that most option contracts expire worthless. In terms of its shareholder structure, institutional owners hold about 300% of all outstanding shares. The biggest shareholders include Apollo Management Holdings, Vanguard, and Millennium Management. It's relevant to understand the shareholder composition of a company, as this can help us to determine if you should be holding the stock long-term or to trade it short-term. So, if the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Although I have to say, in this case, given that it's owned by institutionals for more than 100%, it simply means that they have borrowed a lot of shares from the brokers to short the stock. Of course, different data aggregator websites would give you different information, so in this case there's 300%, but it doesn't mean that they truly short 200%. This may be a glitch or just a difference in the way they calculate things. According to most other websites, it's around 40% of the short interest at the moment. So typically, the consensus for other stocks is that there should be between 25 to 30% of institutional participation for the stock to be a good investment and not just a short-term trade, although in this case I have to say it is an exception. So obviously there's a lot of exceptions to what I just said, since many great companies are also held by retail investors for the most part, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes when there are significant short interest in the total volume, this may be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 45% of the total float, and 53% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant chunk of it coming outside of the public exchanges, this may suggest that there are institutional positions taken to short the stock and that there would be potentials for a short squeeze. My recommendation is therefore to buy Redbox and to hold it until the short interest begins to decrease significantly. I would recommend to commit between 1 to 3% of your portfolio's capital in Redbox. I would also recommend to split the allocation in at least 60% now and 40% later so that you can purchase more in case it further retraces, but if it doesn't, at least you have enough to benefit from the upward momentum. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand. which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.